One of the key functions of money is to act as a store of value over time, a way to preserve the purchasing power of our work and our savings. Yet, that purchasing power gradually declines year after year. The evidence is easy to see in everyday life. The prices of common goods and services rise over time, revealing how money's value quietly erodes in the background. To illustrate this, let's compare the cost of a few common items from 10 years ago in 2015 to their prices today in 2025. According to the official data from the US Bureau of Labor Statistics, a gallon of milk that cost around $3.30 in 2015 now averages just over $4 in 2025. A dozen eggs, once roughly $2, now averages $3.60. The national average rent tracked by the US Census Bureau has risen from around $1,000 a month in 2015 to roughly $1,500 per month today. While gasoline prices have fluctuated, the average gallon of regular gasoline has climbed from around $2.40 to over $3.30 during the same period. This is what currency debasement looks like in everyday life. Prices rise not necessarily because goods become more scarce, but because money becomes more abundant. While the change feels slow year to year, over a decade, the loss of purchasing power is unmistakable. In this video, we'll explore how currency debasement works, why it happens, and what it means for your finances. Currency debasement occurs when a government or monetary authority increases the supply of money, which gradually reduces the value of every unit already in circulation. In other words, as more money enters the system without a matching increase in real goods and services, each unit of currency buys slightly less than it did before. Currency debasement is nothing new. It's as old as money itself. In ancient times, this process was physical. Rulers would recall gold or silver coins, melt them down, and mix in cheaper base metals such as copper. The reissued coins looked identical, but their metal content and therefore their real value had quietly fallen. The leftover gold or silver was often kept by the state to fund wars, pay soldiers, build monuments, or support raw spending without raising taxes or borrowing openly. This allowed governments to extend their resources, while citizens unknowingly absorbed the cost through the declining value of their money. Fast forward to today, the process looks different, but the principle remains the same. Instead of melting coins, governments now create new money digitally. Central banks can expand the money supply with policy decisions or balance sheet adjustments. This could be done for many reasons: to stimulate economic growth, to finance government spending, fund wars, or ease the burden of rising debt. But the outcome is similar. When the supply of money grows faster than the real economy, purchasing power declines. To put things into context, imagine a small economy with $1,000 in circulation and 1,000 apples for sale. Each apple costs around $1. Now, suppose the government doubles the money supply to $2,000, but the number of apples stays the same at 1,000 units. Buyers now have more money, but there are no more apples to buy. There is twice as much money chasing the same amount of goods. Sellers respond by raising prices, and soon each apple costs $2. The currency buys less not because apples have become more valuable, but because money itself has become less scarce. The same logic applies to the real world. As the supply of dollars expand, scarce assets such as gold, silver, real estate, and equities tend to rise in price, not necessarily because their intrinsic value has changed, but because the unit measuring them, the currency, has weakened. Nowhere is this dynamic more visible than in the United States, where national debt has reached historic levels. As of late 2025, the US national debt stands at over $38 trillion, and projections suggest it could exceed $50 trillion within the next decade. On a per-person basis, that's more than $105,000 owed per American. The debt-to-GDP ratio, a key measure of sustainability, has climbed above 120%, the highest peacetime level in US history. This means the government now owes more than the US economy produces in an entire year. When debt grows faster than the economy, policymakers face a limited set of options: default, austerity, or currency debasement through money creation. Option 1, default. Defaulting on debt, or refusing to pay existing debts or restructuring payments, is the most direct option, but also the most damaging. Historical examples include Russia in 1998, Argentina in 2001, and Greece in 2012, all of which faced severe recessions, collapsing currencies, and long-term loss of investor confidence. For the US, a default would undermine the credibility of their US Treasury bonds, which are considered the global benchmark for safety. The ripple effects across global markets would be severe, very likely ending the dollar's role as the world's reserve currency. Option 2, austerity. The second option is austerity, cutting spending, raising taxes in order to rebalance the budget. This in theory restores fiscal discipline, but in practice, this is politically unpopular and economically painful. For context, the US has recorded a budget surplus in only 5 out of the past 60 years, with the remaining 55 years in a budget deficit. Large spending programs such as Social Security, Medicare, and defense accounts for most federal outlays, making meaningful cuts difficult. Examples from Europe's debt crisis from 2010 to 2015 shows how austerity can lead to slower growth, rising unemployment, and social unrest, often forcing governments to reverse course. Option 3, printing more money. The third and most common path is to finance debt through money printing, i.e. currency debasement. Rather than formally defaulting or cutting spending, governments can print more money and allow inflation to reduce the real value of their debt. This approach is politically easier as the costs are dispersed across the economy through gradually higher prices. And historically, this method has been used repeatedly. After World War II, Britain financed reconstruction through money creation, leading to decades of steady inflation. In the 1970s, the US financed growing deficits after leaving the gold standard, resulting in double-digit inflation and the loss of bondholder purchasing power. In Japan, from 2010 onwards, continuous monetary easing kept debt serviceable, but contributed to prolonged stagnation and yen depreciation. Each case shows a similar pattern. Expanding the money supply can temporarily ease debt pressures, but over time it erodes currency value and public trust. Here we can see the rate at which the US dollar has been debased through the rapid expansion of the M2 money supply. The M2 money supply represents the total amount of money readily available in the economy, including cash in circulation, checking and savings deposits, and other easily accessible funds. It's one of the most comprehensive measures of liquidity in the financial system. Over the past several years, especially during and after the pandemic, M2 has surged at the fastest pace in modern history, illustrating how monetary expansion directly contributes to the declining value of money over time. Considering the 3 options to deal with the government debt, default is economically disruptive, austerity is politically difficult, while printing more money, though gradual and less visible, becomes the path of least resistance. So what does all of this mean for individuals trying to protect their wealth? Well, most savings vehicles, such as cash deposits and short-term government bonds, struggle to keep pace with inflation during certain periods. Even when nominal bonds appear positive, real returns, that is adjusted for inflation, can be close to zero or even negative. As of late 2025, short-term US Treasuries yield around 4%, while official inflation, measured by CPI, sits near 3%, leaving a real return of around 1%. If the Federal Reserve continues cutting interest rates into 2026, as markets expect, real rates could turn negative yet again, meaning savers would lose purchasing power even as their account balances grow. In such an environment, investors often begin reallocating their wealth towards assets that can better preserve value. Historically, these assets include gold, silver, commodities, real estate, and more recently, Bitcoin. All assets that share one important feature: scarcity. To revisit the earlier analogy, an economy with $1,000 in circulation and 1,000 apples, the apples represent the limited assets within that system. As the money supply expands, but the number of apples remain the same, each apple becomes more expensive in dollar terms. The same principle applies to real-world markets. While governments can create more currency, the supply of precious metals, property, and other tangible assets remain largely scarce. As a result, their prices tend to rise, not necessarily because they become more valuable, but because the money used to buy them becomes less so. This gradual shift away from fiat currencies and traditional savings vehicles towards scarce, tangible assets is even gaining momentum across Wall Street. A growing number of institutions are recognizing the need to preserve value in an environment of persistent monetary expansion. For example, Morgan Stanley recently adjusted its model retail portfolio from the traditional 60-40 split between stocks and bonds to a 60-20-20 structure, adding gold as a permanent component rather than a temporary hedge. To put this into context, the global bond market is valued at around $128 trillion, while gold's total market capitalization sits at $30 trillion. Yet the average US investor currently holds less than 1% of their portfolio in gold. Even a small reallocation from bonds into gold could represent a major shift in demand and gold valuation. This trend, often called the debasement trade, reflects a broader strategic response to persistent monetary expansion. It's not necessarily about seeking higher returns in your portfolio, but about preserving purchasing power in an environment where fiat currencies are steadily losing real value. Currency debasement is not a new phenomenon. It has simply evolved with technology. Where rulers once diluted silver coins, central banks today expand digital money supplies. The outcome, however, remains the same. Over time, the value of money declines. Inflation, in this sense, is not just a rise in prices. It is a visible outcome of a deeper process, the creation of money faster than the growth in real output. This process shapes entire economies. It tends to benefit borrowers and asset holders, while penalizing savers and those relying on fixed incomes. The transfer of value happens quietly, not through taxation, but through the gradual dilution of purchasing power. For individuals, understanding this mechanism is essential. In a world where fiat currency can be created in unlimited quantities, value must be grounded in scarcity. That may mean owning productive businesses, tangible assets, or scarce monetary alternatives like gold and increasingly digital assets such as Bitcoin. The principle is straightforward. Governments can create money, but they cannot create value. Recognizing that distinction and positioning your finances accordingly is the key to maintaining purchasing power in an era of perpetual currency expansion. If you found this video useful, please like and subscribe for more insights into economics, investing, and global markets. Thank you and have a wonderful day.